Welcome to WealthStream Academy. Today we present the fastest way you can live off dividends. Financial independence through dividends is an increasingly relevant topic in today's fast-paced world, where traditional employment may not provide the security or satisfaction many seek. Financial freedom refers to the ability to live life on your own terms, free from the constraints of financial stress and the need to work for a paycheck. This concept has gained traction as individuals strive for a lifestyle that allows them to pursue passions, travel, or spend more time with loved ones without the burden of financial obligations. In this discussion, we will explore various strategies for earning passive income through dividends, which can serve as a reliable source of revenue. We will delve into the importance of investing in dividend-paying stocks, building a diversified portfolio, and reinvesting dividends to accelerate wealth accumulation. By focusing on these strategies, you can create a sustainable income stream that grows over time. Imagine the potential benefits of living off dividends: the freedom to retire early, the ability to fund your dreams, and the peace of mind that comes from financial security. As we navigate through these strategies, we will highlight real-life examples of individuals who have successfully achieved financial independence through dividends, showcasing the transformative power of this approach. Join us as we uncover the path to financial freedom and the steps you can take to start living off dividends, ultimately empowering you to take control of your financial future. Dividends are a portion of a company's profits that are distributed to its shareholders, serving as a reward for their investment in the company. For shareholders like John, dividends hold significant importance as they provide a tangible return on investment, contributing to overall financial growth and stability. When a company generates profits, its board of directors may decide to allocate a portion of those earnings to shareholders in the form of dividends, reflecting the company's commitment to sharing its success. The process begins with the company's board declaring a dividend, which is then communicated to shareholders along with the payment date and record date. This ensures that only those who own shares by the record date will receive the dividend payment. Dividends can take various forms, with cash dividends being the most common, where shareholders receive a direct payment, typically on a quarterly basis. Alternatively, companies may offer stock dividends, where additional shares are issued to shareholders instead of cash, allowing them to increase their ownership stake in the company. Another option is a dividend reinvestment plan, DRP, where dividends are automatically reinvested to purchase more shares, compounding the investment over time. This flexibility in how dividends are distributed allows shareholders like John to choose the method that best aligns with their financial goals, whether they seek immediate income or prefer to grow their investment further. Understanding dividends and their workings is crucial for investors aiming to maximize their returns and achieve financial independence. Dividend yield is a key financial metric that helps investors assess the income generated from their investments in dividend-paying stocks. It is calculated using a simple formula: divide the annual dividend payment by the stock's current market price, then multiply by 100 to express it as a percentage. For example, if a company pays an annual dividend of $2 per share and its stock is currently priced at $40, the dividend yield would be 5%. This figure provides insight into the return on investment relative to the stock price, making it an essential tool for investors like John. It's important to note that dividend yields can vary significantly among different companies and industries. Some companies, particularly those in mature sectors, may offer higher yields as they distribute a larger portion of their profits to shareholders. Conversely, growth-oriented companies may have lower yields as they reinvest profits to fuel expansion. Understanding these variations is crucial for investors seeking to align their portfolios with their financial goals. Moreover, grasping the concept of dividend yield is vital for making informed investment decisions. A higher yield may seem attractive, but it can also indicate potential risks, such as a declining stock price or unsustainable dividend payments. Therefore, investors should consider yield in conjunction with other financial metrics and the overall health of the company. By comprehensively evaluating dividend yield, investors can make strategic choices that enhance their chances of achieving financial independence through dividends. One effective strategy for earning dividends is through covered call exchange traded funds, ETFs, which combine stock ownership with options trading to generate income. Covered call ETFs generate income by holding a portfolio of stocks while simultaneously selling call options on those stocks. This strategy allows investors to benefit from stock appreciation and receive dividends from the underlying stocks. When the stocks appreciate, the ETF can capture gains, and when the options are exercised, the premiums collected from selling the calls provide additional income. Popular covered call ETFs include the Global X NASDAQ 100 Covered Call ETF, QYLD, which typically offers a yield around 11%, and the Invesco S&P 500 Buy Right ETF, PBP, with a yield of approximately 7%. These ETFs appeal to income-focused investors looking for a blend of capital appreciation and regular income. However, it's essential to understand the risks associated with this investment strategy. One significant risk is that if the underlying stocks experience substantial price increases, the ETF may miss out on potential gains, since the call options will cap the upside. Additionally, if the market declines, the losses on the stock holdings may not be fully offset by the income generated from the options premiums. Investors should also be aware of the potential tax implications of options trading and how they may affect overall returns. By carefully considering these factors, investors can determine if covered call ETFs align with their financial goals and risk tolerance while seeking to earn dividends. The second strategy for earning dividends involves investing in real estate investment trusts, REITs, which are companies that own, operate, or finance income-producing real estate across various sectors. REITs provide a way for investors to gain exposure to the real estate market without the need to directly purchase properties. They operate by pooling capital from multiple investors to acquire and manage a diversified portfolio of real estate assets, generating rental income and capital appreciation. By law, REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends, making them an attractive option for income-seeking investors. Examples of high-yield REITs include the Annaly Capital Management, NLY, which typically offers a yield around 10%, and the Realty Income Corporation, O, known for its monthly dividend payments and a yield of approximately 5%. While investing in REITs can provide substantial rewards, such as regular income and potential for capital growth, it is essential to consider the associated risks. Market fluctuations can impact property values and rental income, leading to volatility in REIT share prices. Additionally, economic downturns can affect occupancy rates and tenant payments, which may result in reduced dividends. Investors should also be aware of interest rate risks, as rising rates can negatively impact REIT valuations. By understanding both the potential risks and rewards, investors can make informed decisions about incorporating REITs into their portfolios as a means of earning dividends and achieving financial independence. The third strategy for earning dividends focuses on investing in dividend aristocrats, which are companies within the S&P 500 that have consistently increased their dividends for at least 25 consecutive years. This impressive track record signifies not only financial stability, but also a commitment to returning value to shareholders. To qualify as a dividend aristocrat, a company must meet specific criteria, including being a member of the S&P 500, having a history of dividend increases, and maintaining a market capitalization of at least $3 billion. Examples of well-known dividend aristocrats include Coca-Cola, KO, which boasts a yield of around 3%, and Johnson & Johnson, J&J, with a yield of approximately 2.5%. These companies have demonstrated resilience and the ability to generate steady cash flow, making them attractive options for income-focused investors. Investing in established companies with a history of increasing dividends offers several benefits. First, dividend aristocrats tend to be financially sound, often weathering economic downturns better than their peers. Their commitment to raising dividends can provide a sense of security as it reflects management's confidence in the company's future prospects. Additionally, the compounding effect of reinvesting dividends can significantly enhance total returns over time. By focusing on dividend aristocrats, investors can build a portfolio that not only generates reliable income, but also has the potential for capital appreciation. This strategy aligns well with the goal of achieving financial independence through a steady stream of dividends, making it a compelling choice for long-term investors. To help John achieve his financial goals through dividend investing, it's essential to break down the required investments for each strategy discussed. For covered call ETFs, John may need to invest a minimum of $10,000 to build a diversified portfolio that generates a reasonable income stream. Given the average yield of around 7% to 11%, this investment could provide him with a solid monthly income. In contrast, investing in real estate investment trusts, REITs, typically requires a similar initial investment, around $10,000 to access high-yield options like Annaly Capital Management or Realty Income Corporation, which can yield between 5% and 10%. When it comes to dividend aristocrats, John might consider starting with a slightly lower amount, perhaps around $5,000, as many of these established companies have lower yields, generally between 2% and 3%. However, the long-term benefits of investing in these stable companies can lead to significant capital appreciation and reliable income over time. It's important to highlight the differences in capital needed for traditional stocks versus the strategies presented. Traditional stocks may require more capital to achieve similar income levels, especially if they do not have a consistent dividend payout. As John evaluates these strategies, he should consider his own financial situation, risk tolerance, and investment timeline. By understanding the investment amounts needed for each strategy, John can make informed decisions that align with his financial goals and work towards achieving financial independence through dividends. In summary, we've explored several effective strategies for earning passive income through dividends, each offering unique benefits and considerations. First, we discussed covered call ETFs, which allow investors to generate income by combining stock ownership with options trading. Next, we delved into real estate investment trusts, REITs, providing a way to invest in income-producing properties without direct ownership. Finally, we highlighted the value of dividend aristocrats, companies with a long history of increasing dividends, offering stability and potential for capital appreciation. Understanding these strategies is crucial for effective financial planning. Each option requires different levels of investment and carries its own risks and rewards, making it essential for investors to assess their financial situations and goals. By carefully considering these factors, you can make informed decisions that align with your aspirations for financial independence. We encourage you to engage with us by subscribing to our channel, liking this video, and sharing it with friends or family who may benefit from these insights. Your support helps us continue to provide valuable financial content and empowers others to take control of their financial futures. If you have any questions or topics you'd like us to cover in future videos, please leave a comment below. We're here to help you navigate the world of investing and achieve your financial goals. Thank you for watching, like, subscribe, and join our community for more trading insights.